Hello there, folks. Yesterday, Rishi Sunak and his team announced some very welcome new loans called the Bounce Back Loans, where you're able to apply for a loan of up to £50,000, which is 100% backed by the government. Now, the full details are still to be announced of this scheme. The actual details that they have announced so far are covered on our website, so we're not going to be going into more depth on that today. But what we wanted to talk about was whether these loans are right for you and your business. When we're looking at any business taking on debt, we have to consider, is this going to be good debt for that business, or is this going to be bad debt? A lot of you will be wondering, what is good debt, what is bad debt? We look at it very simply in one of two ways. Bad debt is generally debt where you're buying something that you can't otherwise afford, but actually it's not really adding any value to the business, or at least not putting you in a better position than if you hadn't otherwise taken that debt on. Good debt, on the other hand, is where you take on a loan and it allows you to, again, do something you couldn't have otherwise done, but through doing that, your business adds an awful lot more value to itself, much more so than it ever would have done had it not taken on that debt. So the chance to get 50 grand without having to pay anything for the first 12 months seems phenomenal, and a lot of you will be thinking, cash is going to be pretty tight, so I might just tap into that might save my business, and that's great. But I think what we want to cover today is a few of the key things that we will consider with our clients when they are going through this application process. Firstly, when we're considering if debt is good debt, we want to see if it's going to be used to buy an income generating asset. If, for example, this debt is going to be used to buy a new piece of machinery that you use in your production process, and that clearly is going to generate more income over the life of that machine, then that generally is good debt, so long as the income that it generates is more than it costs to pay off that debt. So, for example, you take the full 50 grand, let's say with interest you're paying back 900 a month. If the new machine that you've bought as a result of this, after its operating costs, generates profit of 1200 a month, then clearly you are £300 better off a month through taking on that debt. If, however, it only generates an extra 600, then actually, cash flow wise and profit wise, you are worse off by having taken on this debt. Employees are also considered within the income generating asset area. If, for example, you have a bunch of work that you know is ready to go, but you don't have capacity to do it at the moment, does this money then give you access to the funds that you can use to pay that employee meantime, just to get that work out the door, and then you're going to claw back more income as a result? If that's the case, then it's probably good debt. If you're doing it with a view to growing and you're less certain whether there's actually that income out there and that work to be done, that's something that maybe needs to be considered a little bit more carefully. The other area that we can look at, income generating stuff aside, is the cost saving side of things. Now again, if you've got an old banger of a vehicle and it's costing you a ton each year in repairs and maintenance, then it might make sense for you to buy a new vehicle where your ongoing costs are going to be slashed, and actually those cost savings effectively would outweigh the cost of repaying that loan. If that's the case, then yeah, potentially this is good debt. If, however, you're thinking this is a chance to get some cheap lending to buy this shiny new vehicle that you've wanted for a while, but it's not actually going to add any value to the business, it's not really making much of a difference in terms of cost savings, we would maybe urge a bit of caution around that. That's probably not good debt and sits, I would say, pretty much in the bad debt category. Similarly, we mentioned machinery before. If you've got an old machine that's kind of, you really could do with replacing, again, same sort of considerations. If the cost savings are going to outweigh the cost of the investment and the cost of repaying this loan, then yeah, potentially that does make a lot of sense as well. Another area that we see a lot of savings being made is just actually through efficiencies. Now, this COVID-19 period, when everyone's been having to work from home and find new ways of working, has resulted in a lot of businesses really thinking about how they actually carry on their day-to-day work. This is great because they're really getting a chance to kind of step back, start from scratch and go, hold on, could we be doing this better? Through this, we're seeing a lot of people investing in software and technology, which should have a really good long-term impact on that business. So again, if this money provides you with the capital to invest in new computers or new software or something like that that's going to create a lot of efficiencies internally, that hopefully should reap benefits for a lot of years to come. And again, if those efficiencies allow you to not only save costs in terms of internal admin, but also then have the additional capacity to generate more income, then as long as the combined savings and extra income outweighs the cost of repaying this debt, then happy days, it's good debt. If, however, you're seeing this as a chance to get some cheap lending just to boost the average kind of balance that you've got in the bank because you know cash flow is going to get a bit tight, again, we would urge a wee bit of caution around that. Yes, it can potentially do that, and yes, some businesses will need it just to get through, but just doing it on the basis that you think it's going to get tight is not really enough. You need to actually have a plan to go, yes, it's going to get tight, but this solves that problem because of X, Y, and Z. And I think this is where it's really important for businesses to sit down with their accountant and really kind of work through the cash flow that's going to happen over the next little while and see if this new debt that's being offered by the government solves the problems that you have at the moment or might have over the next wee while. So I think to wrap up, do the numbers. If this saves more costs or generates more income for your business than it costs to repay, generally for us that sits in the good debt category. And if you can make a situation where this is good debt for you, then yeah, let's take advantage of it. If, however, it's not, and it's actually, when you're being really honest with yourself, just to fund a bit of an indulgence, please try and steer clear of that. You're going to need to be wise with your debt and with your business funding over the next little while. Of course, if anyone needs a hand discussing this, even if you've been running the numbers yourself and you want us to just cast an eye over it, that is something that we can do. We can do it ourselves. We can do the full cash flow for you if you want, but we are seeing a lot of folk that are picking through the numbers themselves and then just want a kind of an independent eye cast over it at the end. That's something we're more than happy to do. And if anyone has any questions on good debt and bad debt, stick it in the comments below. We'll be more than happy to answer that. Overall, we are very pleased to see this new loans being announced, especially the 100% back-in, because that was one of the problems we've seen with the CBILS loans. The 80% back-in was making some banks a bit hesitant to dish them out, and there was a bit much bureaucracy around it. So hopefully these new loans, when they open on the 4th of May 2020, hopefully they will go out quicker, provide the much needed cash boost to businesses that they're craving at this time, and will help you bounce back, as they say, stronger in the long run. Thanks very much.